Everyone wants to talk about the future once it's obvious, once the returns are posted, once the window is closed. But the real game is played earlier, when the signal is faint, the skepticism is loud, and the opportunity is quietly taking shape. Right now, behind the noise of daily markets and short-term trades, a deeper shift is unfolding. Not in the headlines, not in hype-driven promises, but in a technology powerful enough to redefine how decisions are made, how value is created, and who leads the next era of innovation. This is not a story about speculation. This is a story about foresight. And if you're paying attention, you'll realize we are standing at the edge of something most people won't understand until it's far too late. Capital doesn't move without reason. It moves toward asymmetry, where the downside is understood and the upside is mispriced. When a position is increased aggressively, it's not driven by headlines or hope. It's driven by work, deep work. In this case, the decision to materially increase exposure to a quantum computing company like D-Wave reflects a clear judgment. The market is still underestimating what practical quantum applications can unlock over the next decade. Quantum computing has lived for years in the shadow of theory. Beautiful math, elegant physics, and very little real-world deployment. What makes this moment different is execution. D-Wave is not trying to win every theoretical debate in quantum science. It is focused on solving specific, high-value problems today, optimization problems that strain classical systems across logistics, finance, manufacturing, and artificial intelligence. That focus matters. History rewards the companies that commercialize first, not the ones that sound the smartest in white papers. The increase in ownership wasn't symbolic. It was decisive. When capital is deployed at scale, it signals conviction that the company's approach, quantum annealing, not gate-based general-purpose systems, has a legitimate role in the near-term quantum economy. This is not a bet on science fiction. It's a bet on applied advantage. Optimization is everywhere, routing fleets, managing supply chains, allocating capital, training models. Even marginal improvements in these areas compound into enormous economic value. Markets often struggle with technologies that don't fit clean narratives. Quantum computing is either dismissed as decades away or hyped as an overnight revolution. Both views are wrong. The truth lives in the middle. D-Wave systems are already being used, already generating revenue, already integrated into enterprise workflows. That doesn't mean the risks disappear. The company is still investing heavily, still refining hardware, still operating in a competitive and capital-intensive environment. But risk is not the enemy of investing. Unpriced risk is opportunity. What attracted attention here is not just technology, but positioning. When a company defines a clear lane and executes within it while others chase broader, more abstract goals, it can build defensibility quietly. That's often when the market is slowest to react. By the time consensus arrives, the valuation has already adjusted. Increasing exposure ahead of that curve is not speculation, it's anticipation. There's also a broader signal embedded in this move. The next wave of computational advantage will not come from faster versions of yesterday's machines. It will come from new architectures entirely. Capital that ignores that shift risks being optimized for a world that no longer exists. Capital that embraces it early with discipline and scale, positions itself where growth is structural, not cyclical. This is how long-term investing actually looks. It's not loud, it's not emotional, it's analytical, patient, and unapologetically forward-looking. You identify where the world is going, assess who can realistically deliver, and commit when the numbers and the technology align. In quantum computing, and specifically in practical applied systems, that alignment is beginning to take shape, and when it does, standing still is often the most expensive decision of all. Technology only matters when it moves from theory into impact. That distinction is where most investors get lost. They chase the promise instead of the application. Quantum computing is a perfect example. For years, it has been framed as an abstract breakthrough, something powerful but distant. What deserves attention now is not the concept of quantum computing, but the specific way it is being deployed to solve real problems today. D-Wave's approach is deliberately narrow, and that is its strength. Rather than attempting to build a universal quantum computer capable of everything, the company focuses on quantum annealing systems designed to handle optimization problems more efficiently than classical machines. This is not a limitation, it's a strategic choice. Optimization is one of the most valuable and persistent challenges across industries. Whether it's supply chain routing, portfolio construction, traffic flow, energy distribution, or machine learning training, the world runs on optimization. Even small gains translate into outsized economic returns. What makes this approach compelling is that it meets enterprises where they are. Businesses don't need philosophical breakthroughs, they need measurable improvements. D-Wave systems are already integrated into workflows already. Tested against classical alternatives, already producing results that justify continued experimentation and spending. That matters far more than theoretical supremacy. Markets reward utility before elegance. There's a tendency to underestimate technologies that don't fit a clean narrative. General-purpose quantum computers make for dramatic stories. Optimization machines sound mundane by comparison. But progress in markets is rarely dramatic in real time. It's quiet, iterative, and often misunderstood. The companies that focus on a clear use case while competitors chase broader visions often build momentum without drawing attention. By the time the story becomes obvious, the advantage is already established. This is also a lesson in discipline. Not every technological revolution arrives all at once. Some arrive in layers. First come the narrow tools that work. Then the broader platforms follow. Betting only on the final form means missing the value created along the way. D-Wave represents that early layer, practical, imperfect, but usable. That usability creates data, customer relationships, and learning curves that are difficult to replicate later. Of course, none of this eliminates risk. Hardware is expensive, competition is increasing, adoption takes time, but risk without context is meaningless. The real question is whether the market is pricing that risk accurately. When a company operates in a misunderstood space, with real deployments and a differentiated approach, mispricing is common. That's where opportunity lives, not in certainty, but in imbalance. There's also a broader implication here. Computing power has always reshaped economic advantage. From mainframes to personal computers to cloud infrastructure, each shift rewarded those who recognized the change early and allocated capital accordingly. Quantum computing represents another architectural shift. It won't replace classical systems overnight, but it doesn't need to. It only needs to outperform them in specific high-value areas to justify serious attention. This is how forward-looking capital thinks. It doesn't wait for perfection. It looks for traction, relevance, and a path to scale. It separates excitement from execution. And when it finds a company applying advanced technology to real problems with evidence rather than promises, it leans in calmly, deliberately, and with a long view of where the world is heading. Markets have a habit of waking up all at once. For long stretches, they ignore a developing trend, misjudge its pace, or dismiss its relevance. Then suddenly prices move violently, and everyone pretends it was obvious all along. The recent surge in attention around quantum-focused companies is a textbook example of that behavior. What looks like overnight enthusiasm is actually the delayed recognition of progress that has been quietly compounding for years. When a company's valuation accelerates sharply, the easy explanation is hype. The harder, and usually more accurate explanation is repricing. Repricing happens when new information forces the market to update old assumptions. In this case, the assumption was that quantum computing was too early, too theoretical, and too far removed from commercial reality. That assumption is breaking down, not because the future arrived all at once, but because evidence accumulated faster than expectations adjusted. D-Wave sits at the center of that reassessment. Its systems have crossed a critical threshold. They are no longer experimental curiosities, but tools being tested and used by enterprises willing to pay for performance. That transition from research to application is where value creation begins. Markets consistently underestimate how powerful that shift is. Once customers begin integrating technology into decision-making processes, switching costs emerge, learning curves steepen, and credibility compounds. Rapid stock appreciation doesn't eliminate risk, but it does change the conversation. The question shifts from, will this ever matter, to how big could this become and how defensible is the position? That's a far more interesting debate. Optimization, the core problem these systems address, is not cyclical. It doesn't depend on consumer sentiment or interest rates. It exists in every environment, across every industry, at every scale. Technologies that improve optimization tap into a permanent demand. What's often missed is that markets are not just pricing future earnings, they're pricing belief. When belief changes, multiples change. Early on, belief is scarce and valuations are compressed. Later, belief spreads, sometimes faster than fundamentals can justify. The discipline lies in understanding which phase you're in. When belief begins to catch up to reality, momentum can be rational, not reckless. This doesn't mean ignoring the fundamentals. Revenue growth, cost structure, capital requirements, all of these still matter. But in emerging technologies, traditional metrics lag. They describe the past, not the slope of the future. The more important signal is adoption velocity, who is experimenting, who is expanding usage, and who is building internal capability around the technology. Those behaviors reveal intent, and intent precedes scale. There's also a strategic dimension investors often overlook. When a technology demonstrates even narrow superiority, it attracts ecosystems, partners, developers, researchers who reinforce its relevance. That ecosystem effect can widen a moat before competitors realize one exists. By the time rivals arrive with alternative solutions, the incumbent has already learned what works, what doesn't, and where the yield value lies. This is why sudden market enthusiasm should not be confused with irrationality. Sometimes it's simply delayed clarity. Capital moves quickly when uncertainty collapses. And in moments like this, the goal isn't to chase price, it's to understand whether the underlying shift is durable. When technology transitions from possible to useful, the market's first reaction is rarely its last. Every meaningful investment begins with an honest assessment of risk. Not the kind of risk that fits neatly into a spreadsheet, but the kind that comes from operating at the edge of innovation. Emerging technologies are never clean stories. They are expensive, uncertain, and often misunderstood. That doesn't make them unattractive. It makes them selective. The question is never whether risk exists. It's whether that risk is being priced with enough imagination and enough realism. Quantum computing sits squarely in that category. The capital requirements are substantial. Research cycles are long. Commercial adoption does not follow a straight line. These are facts, not flaws. What matters is whether progress is being made in ways that reduce the most important uncertainties. In this case, the uncertainty is not whether quantum mechanics works, it does. The uncertainty is whether quantum systems can be deployed in ways that deliver consistent, repeatable value to customers. That gap is beginning to narrow. Losses on the income statement are often cited as proof that a company is too early. That's a shallow conclusion. In frontier technologies, losses are frequently a sign of commitment. Heavy investment in hardware, software, and talent is not wasteful if it accelerates learning and shortens the path to scalability. The real danger is underinvestment, reaching the market with technology that works in theory but fails under real-world conditions. Building resilient systems is expensive. Cutting corners in this phase is far more costly later. Competition is another perceived threat. As attention increases, more players enter the field. That's inevitable. But competition alone does not destroy value. In many cases, it validates the opportunity. What separates durable companies from transient ones is not who arrives first, but who learns fastest. Experience gained through real deployments, failed tests, partial successes, unexpected use cases, creates institutional knowledge that cannot be replicated quickly. That knowledge becomes a form of capital. There is also a tendency to underestimate patience as a strategic advantage. Markets demand quarterly clarity. Innovation rarely provides it. The discipline to hold through ambiguity while continuing to evaluate facts rather than narratives is what allows long-term value to surface. Volatility in price does not equal volatility in truth. Often it reflects the market's discomfort with uncertainty rather than a change in fundamentals. Risk, when understood properly, is directional. Some risks diminish over time as technology matures and customers engage. Others grow if execution falters or capital is misallocated. The skill lies in distinguishing between the two. When customer engagement deepens, use cases expand, and systems improve incrementally, the most dangerous risks are already behind you. What remains is execution risk, and that is the kind investors can monitor and manage. There's a broader lesson here. For anyone allocating capital in a world of rapid change. Avoiding uncertainty altogether doesn't produce safety, it produces stagnation. Progress is driven by those willing to engage with complexity, absorb short-term discomfort, and focus on long-term trajectories. When risk is paired with learning and learning compounds, uncertainty becomes an asset rather than a liability. This is how disciplined capital approaches the frontier, not with blind optimism, but with clear eyes, structured patience, and a deep respect for the difference between noise and signal. The future rarely announces itself in a single moment. It arrives gradually, then suddenly, and by the time it feels obvious, the real opportunities have already passed into stronger hands. Long-term capital is built on recognizing inflection points before they become consensus, not when certainty is complete, but when direction becomes clear. Quantum computing is approaching that kind of moment, not as a replacement for everything we know, but as an addition that quietly reshapes what is possible. Every major shift in computing has followed a familiar pattern. Early machines were specialized, expensive, and limited in scope. They solved narrow problems better than anything that came before them. Over time, those narrow advantages expanded, ecosystems formed, and the technology became foundational. Quantum systems today are at that early, specialized stage. They don't need to do everything. They only need to do something valuable, better than classical alternatives. That bar is already being met in specific optimization tasks. What makes this transition important is not speed, but inevitability. As data grows more complex and decision spaces expand, classical computing encounters diminishing returns. More power no longer guarantees better answers. New architectures become necessary. Quantum approaches introduce a fundamentally different way of exploring possibilities, one that aligns naturally with the complexity of modern problems. Once that alignment exists, adoption is a matter of economics, not belief. The companies positioned to benefit from this shift are not the loudest or the most speculative. They are the ones building quietly, refining systems, engaging customers, and accumulating real-world feedback. That process doesn't generate headlines, but it generates resilience. Over time, resilience becomes dominance. When competitors attempt to enter later, they face not just technology, but years of operational learning compressed into a single organization. This is where long-term thinking separates itself from short-term reaction. Markets often struggle to value technologies whose payoff curves are nonlinear. Early progress looks slow. Then capability compounds. Then value accelerates. Investors who wait for clarity often end up paying for certainty rather than growth. Those who engage earlier accept ambiguity in exchange for asymmetric potential. There is also a strategic dimension beyond returns. Technologies that redefine problem-solving reshape entire industries. Optimization touches logistics, finance, energy, healthcare, and artificial intelligence. Improvements in these areas don't just create profits, they create efficiency across systems that society relies on. That kind of impact tends to attract sustained capital, talent, and policy attention. Once that flywheel starts turning, it is difficult to stop. Looking forward, the most important question is not whether quantum computing will matter, but how quickly its advantages will expand. The answer won't arrive in a press release. It will arrive through gradual adoption, deeper integration, and increasing dependence on results that classical systems cannot match. When that dependence forms, the technology stops being optional. This is how the future is built, through disciplined bets on emerging capabilities that align with long-term needs. Not through speculation, but through conviction grounded in analysis. When capital positions itself at these turning points, it doesn't just participate in change, it helps shape it. So when history looks back on this moment, it won't ask who reacted first when the headlines exploded. It will ask who saw the shift while it was still quiet. Who understood that the future doesn't arrive with certainty, it arrives with clues. The next era of advantage won't belong to the loudest voices or the fastest followers, but to those who recognized the signal before it became consensus. This is how revolutions in technology and capital truly begin, silently, deliberately, and then all at once. The question isn't whether this future is coming. The question is simple: when it arrives, will you already be positioned, or will you be watching from the sidelines?